Ask Annex. As always, got a question for us? Head to the website, look for the Ask tab. If we can help, click that Get Started button. Sarah Kyle, Wealth Manager, Annex Wealth Management in the studio. Hello.
Hello.
And we got Matt Morzy, Investment Team Manager and a CFP at Annex Wealth Management. Welcome back.
Hello, sir.
All right. First one is from Bob. Can I contribute to my own Roth IRA and to my work 401k Roth plan?
Yes, Bob, you can contribute to both. It is possible to do both Roth IRA and your Roth 401k at work.
So just load both those bad boys up?
You bet.
Question 2 is from Ted. There must be at least 200 S&P 500 ETFs. What's the difference?
Most likely nothing. They're going to be very, very similar. A couple things to watch out for is first is how are they constructed? So most of them are going to be what's called market cap weighted, which is the largest companies are going to have the biggest impact within the fund, just how the S&P 500 is created. The next biggest group would be equal weighted, which is all 500 so companies. I think there's technically 505-ish right now, are all have the same weight. So the biggest company, Apple, is going to have the same weight as the smallest company within the S&P 500. So that's an equal weighted index. So that's the most important thing to look at. Next would be expense ratio. So how expensive is each one? Most of them, as fees have come down in the industry, have become very, very low, maybe 0.02, 0.03%, something like that. But some of them are more. Expenses are clearly going to pull down your return. If you're investing in the exact same thing, but you're paid more for one versus another one, there's going to be obviously a difference in return there. Next would be liquidity. So how often do they trade? How many shares a day trade? Is it going to be easy to get in and out? Is going to be really important. And then kind of all that sums up into what's called tracking error, which is basically how well does it match its benchmark return. Now, if you have a higher fee, that's going to increase that tracking error. If it's low liquidity, it's going to increase that tracking error. So those are things you're going to want to watch out for, but you're going to essentially want the one with the lowest tracking error when you're trying to compare two S&P 500 funds.
Next one is from Rose. Sarah, it's a 4-parter. So let me read it all the way through. How much can I gift stocks to my son? Can I still do it for 2022? My trading account is in my name only. Can I still gift from there for my husband as well? Are there any restrictions on my son receiving the stock, hold or sell time frame? Let's go one at a time.
Alrighty.
How much can I gift stocks to my son?
So the annual gift tax exemption is $17,000 a year per person per recipient. So if you're married, you can do $34,000. But everybody has a lifetime gift tax exemption. So as of 2023, that is about $12.92 million that you can use to make gifts above the annual exclusion without having to pay that gift tax. But there are some forms you need to fill out if you would do that, and that would be called the Form 709.
How much?
Yeah, almost $13 million.
Is that all?
That's a lot of stock.
Yeah. Okay, second part. Can I still do it for 2022?
No, you cannot. That's based on the calendar year. It's not like a contribution to your retirement account where you have up to the tax date the next year to contribute to the prior year's account. So gifting is based on the calendar year.
Question 3. My trading account is in my name only. Can I still gift from there for my husband as well?
Yes, you can do a gift split, but you would still have to fill out that Form 709.
And the final part, are there any restrictions on my son receiving the stock, hold or sell time frame?
No restrictions.
Happy birthday, son.
Yeah.
Yeah. All right, next question is anonymous. How often do out-of-favor sectors turn around? Are there sectors that are currently out of favor that have long-term opportunities, and are there key indicators?
Yeah, that's a great question. So first and foremost, I would say please listen to our SWOT podcast on Monday mornings that comes out. Our investment team really drills into a lot of this type of information as we go through that strengths, weaknesses, opportunities, and threat framework. A lot of it does relate around different sectors or the market as a whole and kind of where we see opportunity, both short and long term. So I think that's a great resource for you if you got those types of questions. From our point of view, this happens all the time. Sectors are always changing kind of what their leadership is within the market. Really, since the financial crisis, technology has been that one that has really driven a lot of the market return over that time period. But there's some that have certainly trailed, but they do ebb and flow based on what's happening, currently within the market. From our standpoint, we look to see what sectors we like to favor, or sometimes we break that down to what's the factor we're looking for, or ultimately what's the theme we're trying to address. Sometimes that does relate to different sectors, but it might also be subsets as well too. So things that we like right now, energy, and that was a sector that was out of favor for a really long time. But due to the underdevelopment and underinvestment in energy companies and drilling and producing that oil out of the ground, we got to spots, as you saw with gas prices over the last year or so, that had really skyrocketed. That's a lot of free cash flow that's coming to those companies now that we think is really, really attractive, even with the pullback in oil lately. But there's certainly, you could see sector rotation from time to time, and we do like to see that. But sometimes it's, actually good to see just a couple stocks within a sector that might be defying that trend.
And Matt, how often would you say those sectors repeat themselves at that top spot year over year?
It's not very common. There is a lot of rotation. Energy, I think, did lead like 2 years in a row, but it had been like last for quite a while. At one point, the S&P, when you're looking at the weighting of each sector, energy was like 2 or 3% of the entire market. 30 years ago, that was like 30%. So it had pulled back so far that there was a lot of room for that to really kind of skyrocket and still not really change its dynamic within the market as a whole.
Sarah Kyle, Wealth Manager, Annex Wealth Management, thank you.
You're welcome, Danny.
Matt Morzy, Investment Team Manager, thank you.
Thank you.